Hello, everybody. Kirk Spano, April 6th. Today I am in front of the Milwaukee Art Museum. And again, not really. So I just published the Global Trends ETF report for April, and we're going to go through that today. We're going to talk a little bit about inflation, though, right off the bat, because the inflationistas just keep on pounding, keep pounding inflation. And they just keep being wrong. So, where is inflation? This is from Federal Reserve Bank of Dallas, and you can see all the various inflation rate. February 24 and the March numbers will come out probably about the same. What we see is that the highest reading out there for PCE is 4.1%, and then the trimmed and trailing PCEs are much lower. And what we can see is that inflation really is somewhere in the twos or threes, depending on how you measure it. I would typically say that take the highest reading is usually the way to go, just to be safe. But the reality is that the number is lower. And so you're probably looking for inflation right around 3% right now. Those two numbers are pretty consistent. We had a small uptick in February. And you can see that over here at this is Consumer Price Index. The Fed likes PCE, but this is Consumer Price Index. Got just that little uptick, the 3.1%, and I would expect that this will probably jitterbug down and then jitterbug back up and then jitterbug down at some point. Why do I think that? Well, we do know that the secular trend is for inflation to go down. I mean, take a look at this chart. Anybody who's banging the drum on inflation has just missed the last 30 to 40 years. Our last inflation spike was here, came down, and it took a 100-year pandemic that messed up supply chains and gave OPEC a chance to manipulate oil to get inflation up. And as soon as the Fed tightens, it came down. And as soon as the United States started moving supply chains back to America, it started coming back down. What happens when even more of the supply chains are in the United States? That means supply chain disruption, inflation really can't happen anymore. It also means that if we take a look at the other big impact on inflation, which is oil, and oil has been about half of the inflationary impact since World War II, you'd say, well, if our dependence on foreign oil just keeps going down, which it does, and it looks like that the demand for oil is flattening out, which it is, and that demand for oil will slowly turn into falling demand for oil in the 2030s before at some point it falls off a cliff, well, then you can see that inflation really isn't the big problem. And all these people who talk about a commodity super cycle for the last 10, 15, 20 years have been wrong. Why? Because technology keeps improving to the point where we need fewer and fewer resources. Rare earth metals for EVs, cut that in half already. It's going to get cut in half again, and it might get cut by 80 or 90%. They have found better ways to power the EVs and batteries for the alternative energy in your home. So battery technology, braking technology, everything to do with EVs and alternative energy just keeps using fewer and fewer resources because the scientists have made a very concerted effort for 2 generations to try to find materials that are abundant and cheap to use for the energy transition. So we are in a pause a little bit on the energy transition because of finances. However, that is not going to last very long, because as soon as the factories are built, and they're within about a year to year and a half of all being built for the new batteries and the new EVs, and we have a flood of solar panels on the planet, we just have to decide if we're going to buy them from China or not. Maybe that's part of the deal when we cut a deal with China. I think in coming months, we're going to see a deal with China. It'll be before the Democratic National Convention would be my guess, because there's been high-level meetings going on with China for 6, 7, 8 months now. China knows that they need the United States, and they also know that it doesn't pay to go to war over Taiwan, but they have to maintain that relationship in a way that keeps them open to the world. So in my reading of foreign affairs and other geopolitical journals, my guess is that there is a deal with China soon that enables them to export through Taiwan. And the stuff might not even touch Taiwan. They'll just have a stamp Taiwan. And that will allow it to get around different types of sanctions or restrictions or tariffs. I think that's coming. I think that in order to propel solar energy in the United States, we don't necessarily have to produce the panels. We're gonna build everything here because it's here, right? You put the panels on the buildings here, and we can build the batteries here. We're building all sorts of battery plants. So I don't think panels are going to be much of a hindrance anymore. I think that's not so great for First Solar, but I think it's good for the industry in general, because managing the energy and storing the energy is the actual job and work that needs to be done perpetually. Putting solar panels on things, well, that goes away after a while, right? If we solar panel the whole country over the next 20 years, do we really need to have built those things here? What we really need is to monitor the energy here, have the batteries here, have the monitoring systems, have the cloud computing, all that sort of thing has to be here. And it makes sense because the real estate is here. So I would expect to deal with China soon. And that plays into the theme today as I talk about the Global Trends ETF. Another way to look at inflation, pretty clear that it just keeps coming down, down, down. This is over at the U.S. inflation calculator, which I believe is pretty nonpartisan. So in the article I wrote on energy this week, which if see here, I put an article on the free side of Seeking Alpha, or the premium side. And it's basically something we've talked about here. I just repackaged it for them. But I talked about using XLE to increase your oil exposure. That's the easy way. But I also pointed out that folks who sell puts can sell puts, collect the premium, and then just close the position when the price of oil goes up and the oil stocks rally. So this had to do with the geopolitics of the Middle East conflict. I think it's hard to chase energy at this point, but if you want to add some exposure, XLE or selling puts on XLE, I think is the easiest way. As you know, we've been talking about Occidental and Permian and XLE for months and months and months, and Permian Resources, 2 years now. So this wasn't something that we had to chase and catch up to, but I did put this out there for folks who, are trying to figure out, well, how do I get into more oil right now? And the answer is, if you're going to do that, it's a trade, probably not an investment. You should have already been in Permian Resources or Occidental. In fact, I trimmed Occidental this week. I'll just sell a put back on it when it dips, and hopefully it doesn't spike up first. But make good money selling puts there. The story here is that there's two things that are pushing oil prices up. One is the Middle East conflict right now. Iran and Israel, things could get bad. However, it's really Saudi Arabia that's been manipulating the price of oil for going on 4 years now. And they are trying to keep the price of oil up. Here is Brent crude. We see that it peaked over $120 a barrel during the inflationary spike, and when they were completely suppressing new oil supply. They've brought it down, and they're trying to manage it in the 80s. And they've pretty much been able to do it. And it's because, and it has really nothing to do with the United States, we're at record production. We set another record last year, and we're going to set another record this year. And we still haven't really expanded our operations in the Gulf of Mexico, which if we ever had to, we could, but we're going to get the oil from the shale first. So the price of oil looks like it's going to be in the 80s pretty consistently. If it drops into the 70s, that's a bonus. But Saudi Arabia wants the price of oil in the 80s because that's what they need for their budget and for their own energy transition and their own economic transition as they diversify away from fossil fuels. And I think that folks need to really think that through. If Saudi Arabia is trying to diversify away from fossil fuels, that means everybody else probably should be too, right? So let's try to think 2 steps out there, right? Let's not play checkers. Let's play chess. Oil demand right now is in balance. You can see that demand, the blue line, has drifted up post-COVID, and supply has also drifted up. Now, over a very long period of time, you can see that the steep growth of demand for oil, which went from about 70 million barrels a day to over 100 now over the last 30 years, is pretty much, that curve is completely bent. And it's flattening out. And later this decade, towards 2030, it'll be completely flat. And then you're going to see some sort of demand destruction for oil at some point in the 2030s. Markets will respond to that. And as I've told you, and we're already seeing with a couple of countries, and we're going to see it with more, the African countries and Qatar, have already started breaking away from OPEC and just producing what they need to produce for their own sake. And they don't really care about Saudi Arabia. If they can make money at $50 oil, which they can, they're cheaper than shale, they will do that. So we are eventually going to get panic pumping. As EV sales go up, you're going to see more oil hit the market, and you're probably going to see very, very cheap oil later this decade to early next decade. And that's why inflation is just not that big of a deal. Oil has been about half of all inflationary pressure since World War II. And if oil becomes less important, then inflation is a much smaller problem. And in fact, I do think it is deflation that we're going to have to worry about in the 2030s or late 2020s as the last boomers retire. And that's going to require a lot of quantitative easing to push asset prices up, create the taxes to support the economy and the budget. If we cut benefits, if we cut the federal budget, folks, you're in a depression, and that's a really bad thing. So the idea of flattening the spending curve on the federal budget, completely valid. However, the idea that we're going to be able to slash benefits on Social Security or Medicare or anything else, it's frankly, when you look at the numbers, it is completely outside of the range of possibilities unless you just want to hand all your money to the super wealthy. So Global Trends ETF report. Expect some choppiness and potentially a small correction in Q2. Oil is likely to see rising firm price through summer, maybe through the election. Bitcoin is expanding globally, and China might cut a deal with the U.S., which I've already teased. So what are the economic indicators? The economy is really strong, and now it's rebounding again. So we may have faded a recession during this tightening cycle from the Federal Reserve, and now we see that the leading economic indicators are heading up again. Normally, this area here would have been a recession. It was a recession here, it was a recession here, it was a recession here. We avoided a recession. That is really historically remarkable. May not appreciate it, but it is a big deal. And as the economy rebounds into this year and next year, probably see the stock market go bonkers, which is what I projected at the start of the year. However, in 2026, the tax code changes. Hopefully, it can be legislated the right way. You know how I feel about that. I think if President Biden wins or if Gavin Newsom becomes president, then you probably see things get done pretty well. If President Trump wins, it's going to be more of what he did the first time, which is he set us up to get crushed in 2020. And I think it was going to happen even without COVID. Everybody blames COVID, but we were really on an abyss. And I've showed all the charts 100 times that the economy and the stock market were both looking to just completely turn over in 2020, 2021 because of the really bad policy that we got from 2017 to 2020. You know, we had to have a bailout in 2019. Nobody likes to talk about that, but that's what the repo markets required. And I think that I'm going to play it by ear going into the end of the year. We have some investments that probably aren't great investments if President Trump wins, particularly the clean energy investments. And we might have to step out of those for a hot minute. But I think that the long-term trend is clearly on their side. It's just that there might be a trade that we have to make. But leading economic indicators all turning up right now. So the idea that the economy is in the doldrums, you just can't see it. Unemployment is 3.8%. It dropped, right? We added 303,000 new jobs. The labor force participation rate has gone up and is almost at the point where it had leveled off here. I don't know that we're ever going to see this again, not with AI, but I think that labor force participation maybe adds a couple more points, but this is probably the labor participation plateau. And as boomers retire, this number will go up just as a function of mathematics. But then as we add immigration, which we should, then that should flatten it back out. So we're going to see labor force participation in the low 60s, maybe up to the middle 60s for a very long time. Back when I studied economics, we always talked about 5% unemployment being the full employment rate. And I think that depending on what labor force participation is, that can be right. So if we would go back to labor force participation in the upper 60s, then probably 5% unemployment is full employment. But with labor force participation in the lower 60s, then probably 4% is full employment. So any tick above 4% on unemployment, you have to watch carefully, because if it's more than a jitterbug, if it's actually rising towards 5 and 6, that's a problem. That's recessionary. The Atlanta Fed's GDP now is 2.5%. At a 3% GDP, the federal budget is almost balanced. So you can see where growth would be important. So I think that the Federal Reserve knows this. I think they know that higher growth pays for a lot of things. And if we simultaneously see the federal budget start to flatten, or at least the growth rate dissipate, and growth for rebuilding the world, a phrase that you haven't heard me say lately, but if you've been around, you've heard me say it a lot. As we rebuild the world and make it more sustainable, and we include alternative energy, and we all switch to EVs and everything else that we can switch to, 3% growth rate isn't that hard to envision. 4 and 5% growth in the United States would be tough. However, surges for a year or two into that range can happen, and that would give you a smooth growth rate around 3% if things are handled well. The infrastructure bill that was passed by President Biden and the Democrats is extremely helpful for that. The semiconductor bill, which was bipartisan, extremely helpful for that. The Inflation Reduction Act passed by the Democrats, extremely helpful for stimulating growth. So we are close to being able to grow ourselves past what otherwise would be a credit crisis and a financial collapse as the boomers retire. We have everything lined up for dealing with it well. However, there is a wild card in the political system that could blow that all up. And we will see. The US dollar has been on a bull market for 12 years since I predicted it on Market Watch. I mean, that's a pretty clear trend, isn't it? Dollar has chopped its way higher. I believe that this range, which I'm going to dub the millennial dollar, about $10 either direction of 100, which is par, is where the dollar index is going to be. Why? Because we're going to manage it that way. If we didn't suppress the dollar with quantitative easing, and we're going to have to anyway because of the boomer retirement, if we didn't have to do quantitative easing for the boomer retirement, I think you'd see the dollar get all the way back up here. The dollar is ridiculously strong to every other currency on the planet. Frankly, only Bitcoin challenges it, not China, not Europe, not Japan, not any of them. The dollar should be the strongest currency on the planet. This is what happened when Volcker beat inflation. The dollar surged. You got a little bit of spike beating inflation this time, and it's because inflation wasn't that big of a problem this time. It was an annoyance. People got to chant inflation, but it's almost gone. And really, at some point, not too distant future, we're going to be talking about how to fight deflation. So I believe that the millennial dollar is going to be in this range. I think we get a little uptick in the short run because we don't want oil prices to go up and mess with the politics. I think you're probably going to see Strategic Petroleum Reserve tapped for a few months over the summer anyway. And then I think the dollar weakens a little bit as we tick down interest rates just a little. I sent Austin Goolsbee a personal message saying, hey, man, you should support the one and done cut, or the one and maybe this isn't a cycle cut. I told him a half point in May made the most sense. I told him why. We'll see if it matters. I think it happens in June, though. I think that there's a 50 basis point cut to interest rates in June, and that they say this might not be the start of a cycle. This might just be taking off the last cut. I think that that is gaining traction. 2 Fed presidents have kind of mentioned it in a sideways way, and that Austin Goolsbee clearly would be in that camp. So I think they just have to get Janet Yellen on board. If Janet Yellen is on board, then Jerome Powell is on board. So I think we see the rate cut in June. That drops the dollar just a little bit and stimulates the second half rally in the stock market. I didn't put up a chart for the treasuries. However, if you take a look, dipped here, span. Treasury market is dipped and it caught a little bit of strength this week, but not much. If the price of TLT gets into the lower 80s, I'd say 82, 83, 84, I start to get pretty interested, and I would use this primarily as recession insurance. I use the phrase in here somewhere. In any case, what could stir a recession? Not many things. They would have to be exogenous. The United States economy is so strong that I'm actually writing an article titled, Don't Call the U.S. Economy Goldilocks, Call it Goliath, which means that obviously Goliath can fall a lot further. However, the reality is that the United States economy is that strong that it would take a global shock of some sort possibly China, possibly Europe to disrupt the global economic system. China's the biggest risk. There's really no doubt about that. Europe is probably second, and then everybody else, but everybody else is small. So, the four biggest economies are the United States, China, Europe, and Japan. And then India finally hit fifth. California is sixth. And you really have to see the potential for China just to go tiger versus, trying to make friends. So we could see the potential for a global recession if China got belligerent and just wanted to burn it all down like the Joker in Batman movies. We'll see. I don't think that's going to happen, but it is a risk. And if China messes with supply chains like they did the last few years, which is why we're moving supply chains here, then what happens is you get stagflation, because not only does the economy get weaker, but you have inflation because of the supply chain. They have a little bit of leverage right now. That's why I think there's going to be a deal now, because that leverage, and everybody knows it, this isn't me speculating, their leverage dissipates once these fabs and factories are online in the United States in 25, 26, and 27, right? The ground is already broken. Buildings are already going up. They're tooling. They're getting ready. They're installing the new technology. AI is figuring it out. So China's best bet to cut a deal that helps them is now, which is why I kind of expect it. So I don't think that I'm too interested in treasuries because I just think they're going to be choppy. But if the price gets low enough for certain accounts, for retirees, for 401k plans, I'd probably add a little bit of TLT as insurance. U.S. stock market is still overvalued, but not as dramatically. It was here and here. It's similar to where it was in the 60s and 70s. And then we got a choppy market for a long time. Now, I want to give you an analogy. The choppy market of the 60s, late 60s and 70s is when Warren Buffett made his most money, because he just found position trade after position trade and found great franchises on the cheap from time to time that he was able to buy and make a ton of money on. I think that you're going to see the S&P 500 peak next year and then enter a choppy phase that lasts 3, 4, 5, 6, 10 years, a long time. Hard to know. I think the better part of a decade would make a lot of sense to me. So until the early to middle 2030s, indexers could have a hard time. I talk about the indexing in this article again. Indexers, because they indiscriminately invest in the S&P 500, it's about half of the money going into the market, don't make any judgments about the value of a company. They just put their money. It's the stock market. It goes up. That's their mentality, the boggleheads. What happens with human psychology, however, is that as an asset starts to underperform, some of the people move away, and then more of the people, and then more of the people, and then it falls off a cliff, and then it rebounds because smart money gets in at the bottom. I think you're going to see a repeating cycle, probably a triple top in the 6,000s on the S&P 500 that will first hit next year, then a few years later, and then a few years later. So it might take, like I said, the better part of a decade to break out to a new high, or much of a new high, more than a minor overshoot after that. And that means that every other year, every third year, 2 out of 3 years, there'll be good tax receipts. And then the other year there won't be. And that'll be a year where the government can do something, crisis response, right? Never let a good crisis go to waste. I think that's how we get through the boomer retirement crisis, is a choppy period where good investors can make a fortune, right? You're set it and forget it. Your indiscriminate investors, they're going to at best run in place, and a lot of them will panic and sell bottoms and lose money. But if we can smartly buy the troughs, trim the tops, and sell the tops, and we don't have to be perfect, we just got to be close, scaling in, scaling out, playing the ebb and flow every few years, every 2, 3, 4 years. I think that we're probably going to do very well in the next decade. In fact, as well as I've done the last 20 years with my own money, turning about $400,000 invested over the last 23 years, basically adding a zero, a little bit better than a zero. I think that I can take this middle 7-figure number that I got. I think I might be able to add a zero again. Not enough to buy the Brewers, but still pretty good. I can help the community a lot with that. So I want people to understand what's probably coming. That's why I talked about the dollar. It's why I show you the valuations. It can't live up here forever. There's going to be choppiness. And I think that the indexers who have essentially broken the market to an extent, and the quant investors, the chasers, are going to give you really good opportunity. If you get caught up in the chasing, you're just not going to be able to keep up with supercomputers and hedge funds and professionals. Just wait for them to give you the big opportunities. Know what you want that's part of the secular trends. And when they hand you something on a golden platter, take it. Don't put out a thimble, put out a bucket. I think one of those opportunities might be coming on the clean energy if Trump wins. Otherwise, we're already plumbing the depths on the clean energy. So there might be a rally short term. And then if Trump wins, you probably see him fall off pretty heavily. And then that would set up another major rally. So we'll see how that trade plays out. Longer term, the clean energy is going to make a fortune. However, it's very volatile, subject to politics, and not easy to invest in because a lot of it is 2, 3, 4 years, 5 years out into the future. But that's when you get your cheapest price. So we'll have to figure it out. Now, we know that last year, the Magnificent Seven was 60% of the stock market gains. Look at this. 7 stocks, 60% of the gains, 493 other stocks, 40%. That is the peak of concentration. What we've seen this year is that's flipped. Why? Apple and Tesla are down. Tesla's down a lot. Apple's down somewhat. So the gains in the Magnificent Seven are only a third of the stock market. That's still a lot, right? NVIDIA. But market breadth is spread out that about 80% of the stocks are going up. Once that number crosses 90%, and especially as it gets to 95%, that's when you get into the danger zone. And that's what happened at the end of 2021 when I warned everybody. Everybody was talking about, oh, market breadth is great. It's 93%. It's 96%, I think it peaked at. I was like, that's bad. That means there's nothing left to go up. So as the market breadth gets from about 80% now, 80% of the stocks going up, to in the 90s, that's when you have to go, okay, probably time to move on. So what am I waiting for? I'm looking for a mini correction in the second quarter, 5 to 10% pullback, and I'll want to buy QQQ on a pullback to about 400-ish. That is Shooter's chart. Then it'll go back up, and then that'll probably be the end a year and a half out. The Invesco Russell 1000 Dynamic Multi-Factor ETF, 2 things I like about it. One is that it includes 500 mid-caps. It's not only the S&P 500, but also 500 mid-caps. And they're only about 20% of the portfolio. However, it plays into the expanding breadth theme. And the mid-caps have been leading because, as I've been telling you for a couple of years now, you're going to have 100 to 200 stocks on the S&P 500 get booted out by the end of the decade. And they're going to be replaced by those mid-caps. We already know that Palantir and a couple others are about to get added to the S&P 500. The other thing I like about this is that it has a very simple quant model that beats the S&P 500 over every rolling time period. So the combination of having the mid-cap stocks in this one on top of the S&P 500 stocks and a basic quant model, right, the mathematics under the market, it does beat the S&P 500. So this is my alternative that I'm using to the S&P 500. If we get a big sell-off in everything, then hopefully I'm smart enough to get out. And then at that point, you just play the cycle, small caps to mid caps to large caps to mega caps, and then it repeats. So there are historical examples that we can use as guideposts. In the international and emerging markets, I just show the emerging markets EEM, broad market. You can see it really hasn't broken out in 17 years. It's a really long time. Jumped up here, but really, that's a long time to be range bound. I expect as the dollar gets stronger in the short term that it comes down. Probably want to buy emerging markets on a 5 or 10% correction because it should challenge this high in the next few years as the dollar starts to get depreciated from quantitative easing. That could start as soon as 2026. I think the emerging markets, which is where most of the growth in the world is beyond the United States, is where we want to be. I'm not positive that we want China, but we're seeing a trough in foreign direct investment in China. And if they cut a deal with the United States, which is what I think is coming, and they'd be silly not to, but we'll see. If they cut a deal with the United States, that means foreign direct investment takes back off. So I do own a fund that has a little bit of China exposure right now. Bitcoin, using IBIT, you can flip that over. If you still have Grayscale, you can switch to IBIT any day. whenever you feel like. iBid is cheaper. They perform the same. I am getting rid of all of my ARC accounts. All of the ARC accounts are already off of the very short list. I just hate the management. I just don't think they do a great job. So I am moving on from them. And in fact, I am going to add a Bitcoin fund to the 401k in the place of the ARC ETF, which had Bitcoin exposure. So I'm just going to go with a pure play on Bitcoin in the 401k, and I'm going to limit that to 5 to 15% of portfolios because I manage OPM, other people's money. If you want more Bitcoin than that, you have to do it on your own. The Bitcoin 401k asset allocation, so I'll have to make that a header. I am now 40% in the Vanguard money market account. I accumulated that over the last 6 weeks, really about a month ago, because I expected some sort of correction. So I sold into the market strength, which is what you're supposed to do. And again, this is OPM. This is other people's money. I have to be more cautious with it than I am with my own money. I am giving the people who have money market balances in their 401k plan, which they should never have, a chance to get involved here without having to reach out on risk. And the asset allocation is great. We bought the iShares 50, which is a couple percent of China, but really Southeast Asia, which is the fastest growing in the world of the developed and semi-developed economies. And then I expanded the Spider Energy Select to 8% of the portfolio from 4 because I could see that oil was going to rise. This has been a top performer this year, and I would expect for it to be overweighted into the summer at least. Energy is only 4% of the U.S. economy now. So to have an 8% position in energy is pretty substantial when other funds also have some energy holding. So this is an overweight in energy. The rest of the balance is pretty widely diversified. Again, I mentioned I'm getting rid of the ARC Web ETF and replacing it with a Bitcoin option. And we'll hold the allocation to between 5 and 15% of Bitcoin within the model portfolio, because if you want more, then you should do it on yourself. And that means that you need to understand it even better. Some closing investment thoughts. I've showed this before. Look, there just aren't a lot of big S&P 500 declines or stock market crashes. They don't happen that often, right? About once a decade, maybe twice. And they always come back. So the very simple ebb and flow trading that I advocate, which is trim near the top, scale in at the bottom. You're not going to be perfect. You just got to be better than the midpoint, right? You got to be below the middle point when you buy, and above the middle point when you sell. And that's not that hard. And if you scale in, you'll beat the market just by virtue of trimming closer to the highs and scaling in closer to the lows, right? That's all you have to do. That will, by definition, you'll beat the market that way. By definition, that's just the math, right? I don't expect this type of correction again until 2026 or 7. And again, we'll see who's running things then. But I'm afraid of a massive financial crisis, a credit crisis, if Trump and his minions get in there. Because the adults that worked with him in the last administration, and none of them want to work with him. So there's very little talent pool for him to draw from. And we'll see. The people who are supporting him now, the billionaire club that just held a dinner for him, is some of the biggest predators in the economy. I mean, I know who these people are. I followed their careers. And, people like Paulson, John Paulson, he's a leech. He made one good trade in his career, and he's been a leech ever since. There's other people too. So, the rich dad, poor dad guy, I mean, he says some things that have some validity, but man, he's just a piece of work too. And, it was very hard for me not to call him a piece of shit. So I think that if we get a small correction, you buy it, but understand that what's coming is a transition period, not only in energy, but in demographic. And it really hits hard in that 26, 27 time frame that I've been telling you about since 2020. We're halfway there. And during the choppy market that might last a decade, give or take, you should get opportunity after opportunity to make trades that double or triple for you in 2, 3, 4-year periods. If you're an indexer, you're probably screwed. If you're a set it and forget it person, you're probably screwed. But that doesn't mean you have to swing trade either. You just wait for the big opportunities that'll probably appear every few years for, again, better part of a decade would be my guess. All right, I see a question. Yay, a question. Let me see what it is. I think that Trump and the Republicans would repeal the IRA, thinking about the risk to one of our stocks. So everybody keeps asking, first of all, let's address the election. The odds of Trump winning are 50-50 at this point. The odds of him getting both houses of Congress are almost zero, probably 10 to 20% based on all the polling. The odds of him being able to beat a filibuster are probably below zero. So the ability to repeal the IRA or any of the other laws is almost zero. The only thing they can do is what's called a reconciliation bill. And that means that they can spend new money or do new tax cuts. So the ability of President Trump to repeal anything is almost nothing. The real risk, if he wins, is that he cuts taxes again on the wealthy who got 85% of the tax breaks. Top 1% of the people got 85% of the tax breaks. That's even more skewed than it was under President George W. Bush, who I actually came to respect, even though I didn't necessarily agree with him on everything. So the risk of a repeal of the IRA, you can answer your own question. What are the odds that Trump wins the presidency, gets 60 senators and a majority in the House? 60 senators thing just can't happen. Can't happen. There's not a mathematical way for it to happen. So with Manchin out, they pick up West Virginia, but they kind of had it to begin with. In Arizona, Sinema's out. That's going to go Democrat. The other states are basically going to split. Trump doesn't have a lot of impact on the down ticket. And the House, which should have been overwhelmingly Republican, is almost 50-50. I mean, that's how things work, is the opposition party usually wins the House in the midterm. And they barely pulled that off. So while Trump and the Republicans might get a small majority, they won't have a big enough majority to actually repeal laws. There's no magic hammer that he can just go, oh, blow that law up, blow that law up, blow that law up. Can't be done. And dismantling the bureaucracy is incredibly difficult. As hard as he tried for 4 years, it's still there. So stop living in cognitive dissonance and understand that laws are laws. This is a nation of laws. And by the way, why would you worry about it now? If he gets elected and he takes Congress, worry about it then. And remember who the IRA is really good for. It's really good for the oil company. It's really good for Harold Hamm, who's supporting Trump, and some other oil guys that are supporting Trump. They don't want to see the IRA repealed. Heck, they want it expanded. They're making all kinds of money. Somebody asked about lithium stocks. So I mentioned lithium stocks a few weeks ago. I think Lithium America is the one. LAC is the symbol. I sold some puts on this one. I wasn't really ready to recommend it outright, but I'll tell you, you probably want to buy the dips on Lithium Americas if you are an aggressive investor. This is a company that came from Millennium Lithium. I believe that's... So I found a lithium company in Canada years ago, 4, 5, 6 years ago, whenever it was. Might have been more recent. And they got bought out like 9 months after I pointed them out. And this is a company that came from that. So learn about this one. And then your big company that you want is Albemarle. If you just want a blue chipper, I mean, look at that channel. So it's going to go up. So this is the hype. This is the, people get tired. And then this is going to be the adoption curve. So I think that if you want the more conservative play, it's ALB. If you want the more aggressive play, it's LAC. And I actually think over here, not exactly lithium, but it is rare earth metals processing. We sold it when it was in the middle 20s. It's come down to the teens. I think it's bottoming out right now. And if you just back out the free cash flow analysis, you'll see that it probably just grows at 10 to 15% a year for a pretty long time. See that, they have a growth rate here of 32%. It's a lot of small numbers. So there probably should be pretty good forward look on this one. Would I buy ALB right now? I'm not buying anything right now. I'm looking for the market to take a dip, but I think they're very close, right? I think it's in the box. If you take a look at LAC, since I made that little trade, it's been rising. So I think ALB does this. I just don't know if it does it quite yet. And I'm greedy. I look for those little extras over and over and over again, because just like small decisions over the course of your life add up into being a good life, small decisions on the investing, looking for a little extra time after time after time, add up to be a lot of money. Have you heard of Arcadium Lithium? I kind of know the name. I haven't studied them. I don't know. When I study these companies, I look specifically at their mining assets and how their jurisdictions work, right? How the laws and tax incentives. All right. I go through the process. Secular trend, government policy, fundamentals of the company. And then I finally look at the technology. And so I don't know what their assets are. But, if they have one or two great assets and they're depressed and they've got the right financing in place, maybe. What about gold and silver allocations in a portfolio? So I will say this for the 17 millionth time. I really don't buy gold and silver as investments in a portfolio. I will trade them occasionally. And if I think there's a trade available, I will tell you. I think gold has run up enough that it's probably not a great thing to buy in a portfolio. Take a look. Your gold bugs have made a curve. Curve might be spikes, but it's a hard trade. The one that I think probably could do it next, well, already did. And we talked about silver back here. So I don't even know if silver is worth it. As far as silver and gold go, silver has more industrial uses. Gold is pretty. It's not money. It's never been money. Well, it was money a long, long time ago. People somehow remember that, but stuff 5 years ago, they don't remember. I think we have investor Alzheimer's. I do. I think that as a group, investors have Alzheimer's, and it's a really weird kind of Alzheimer's where they remember what happened in the last year, but not 5 or 10 years ago, and then they remember things from 1,000 years ago. I mean, is that why that Roman Empire shit is coming back? I mean, I don't really understand that. I'm Italian, and I'm over it. In any case, if you want gold, buy heirloom jewelry for the people you love, some gold coins to show the grandkids, and some little gold bars, in case you have to jump the border. But beyond that, they're trading vehicles. They are not investing vehicles in the securities market. All right, what else do we have? Anything? Going once? Going twice? All right, there is no major markets because Shooter is under the weather. I will edit this afternoon before the main event of my poker league. If I finish about 15th or better, I get an extra $1,500 buy-in into a poker tournament in Vegas this summer, where I am scheduled to be for way too gosh darn long. All right, have a great weekend. Looks like good weather in the Midwest, so enjoy it. And look for a new website that I'm a part of coming, I don't know, over soon, called Climate Castles. ClimateCastles.com. It is going to be Jolene's real estate webpage for folks who are concerned about climate change and they want a place where they don't have to worry as much. So we are going to focus on those types of properties in Wisconsin. $500,000 and up is the general consensus, but there's all kinds of good properties in the Midwest. So if you think you might want a second property where you can hunker down if your part of the world starts to burn or flood or earthquake or tornado, whatever, we're going to focus on that. Second properties, luxury properties for the most part. However, there's all kinds of access to $200,000 condos here, $300,000 condos that are pretty awesome. All right, wish me luck with the poker. It's worth $1,500 to me above and beyond whatever I win tonight. Take care.